This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Mike Dever was my first episode. And now, somewhere in the 800s, he's back on again. Actually, he was on for a second time, I'm fairly certain as well. But wow, so cool that somebody who gave me his time so early on, when this podcast really had 0 people listening, I mean a handful, and Mike, a very experienced money manager, lots of insights, a really interesting Rolodex. Mike came on and gave me his perspective. And now he's back today with one of those great perspectives about the markets, trading, and investing that you need to listen to. It's not the same old, it's a different view. And damn it, if we're looking at the current spring 2020, and you think you don't need a different view, if you think the game is the same old game, you got something wrong with you. Without any further delay, let's jump right into my conversation today with Mike Dever. I'm doing well. How are you?
Doing fine. Yeah, I mean, it's been a very interesting time, obviously. And right now, I mean, the silver lining is I got all 3 of my boys home for a little while, so we get some good family time.
You're outside Philly, is that right?
We are outside Philadelphia.
Yeah, right before I called you, I was thinking, well, I know just from memory, you've been on the show a couple times, but I was thinking, Mike had to have been in the first 10 episodes, and I quickly pulled up my own website because 856 episodes in, lo and behold, you were the first episode. I had forgotten.
That's right. That's a little badge of honor because people will ask me, have you listened to Mike Covel's podcast? I'm going, oh yeah, I was the first episode he ever did. I've always got that now, if nothing else, right?
That's very cool, right?
Oh, yeah, absolutely.
Let me take people back in time a little bit. How long have you been working with clients in the managed money space?
Since 1982.
1982. That's a wide cross-section of market cycles and events, unexpected things, crises, booms, busts, bubbles, pops, corruptions, who knows what. You've seen the full landscape, haven't you?
I've seen a lot. Yeah, it's been very interesting times.
What do you think about from a market perspective? I just saw what a lot of fund managers did for the month of March, specifically some of the ones that happened to be in my books, and they had a pretty damn rocking month. How do you perceive what's unfolding here? And we don't even have to get into trading strategies yet. We can kind of just look at the markets, and you can give some philosophical background about how you see things unfolding and offer some pearls of wisdom. We'll pick it apart over the next hour, but give people some ideas about how you see it with all that experience in the managed money field.
There's some things that are very different from what I've ever seen before, and then there's a lot of things that are highly similar. For me right now, I mean, obviously the difference is the whole fact that there was an event that's triggered global recession, a global slowdown. In the past, those events have been more specific to different geographies. Obviously 9/11, it didn't affect the entire globe the way it affected the United States. And this is the first time where we see something where it's truly affecting the entire world. And I've seen some people misclassify the recession that's being triggered by this as an event type recession, which generally implies that it's going to be shorter in duration, shorter in magnitude, nice recovery, and every setback is a buying opportunity for investors. And I just totally disagree with that. I think this is something that's more like a depression scenario where you have behaviors that are going to change for a generation. Not only that, but you've got immediate economic impact that's going to be global and wide reaching across not just geographies, but industries.
Not that you have perfect foresight or any way to predict what will happen next, but you've just laid out close to 40 years of managed money experience. And for those people listening out there that might have that kind of V-shaped recovery in their mind, which is what all the politicians want to talk about, you're really telling people right now that if you're sitting around thinking you're going to buy a dip and get back to all-time highs in a stable sort of way, that's probably not so wise, huh?
Absolutely. You talk about politicians wanting that V-shaped recovery, and they're talking about it, and everybody's being enthusiastic about the recovery and how it's going to snap back. It's prevalent across the entire financial industry. Just over the past week, I've been canvassing the different large investment banks, the Goldman Sachs, Morgan Stanley, Bank of America, Wells Fargo. So far, the most bearish forecast I've seen is a 4% rise between now and year end. That's bearish. The most bearish person is predicting the market to be higher by year end.
What is the feel? Because you, being in the space for so long, you've got an interesting Rolodex that a lot of people are not going to have. Are there particular stresses? And I'm thinking back to the fall of 2008, because there was a moment in time, September or so, where I kind of felt like, damn, are they going to turn the ATMs off? What are you hearing and feeling? Does it feel like the banking system is solid this time around?
We came in with much better in the way of capital ratios, and obviously interest rates are low for the economy to be able to borrow. But that's just built up so many imbalances that for right now, for example, just this morning, I'm watching the news talking about the mortgage industry in the US, and people aren't really focusing on what is happening there to the extent that it's the negativity. But a lot of these people that are getting these deferrals of their mortgage and payments and interest, I mean, that's just going to go through the entire industry, just kind of trickle down until it has to get backstopped, because there's going to be, the industry wasn't built for that. And it's mostly the mortgage servicers right now that you see trouble with. But it's not that different from what I saw in 2007 and early 2008, when you started seeing a little bit of a ripple here and there of trouble, and then it started into a cascade. We're at that point where we could have that same kind of cascade. And I'm just talking about the mortgage industry right now and the banking industry, which came in relatively sound. But there are a lot of excesses. Corporate debt has increased as people have taken advantage of low interest rates. I think you've got a lot of potential troubles as people start seeing the economy slow.
I mean, if you take, for example, everyone, I'm just generalizing there, but if everyone skips a payment or delays a payment or whatnot, as you say, that trickles down. And okay, eventually perhaps the government says in some way, I don't know how they exactly do this, but we're going to backstop it all. We're going to kind of carry people over this 1 or 2 months, assuming it's only 1 or 2 months. But then again, even if the government somehow or another was able to vacuum everything up, I mean, there's going to be a price, a cost for all this. There's just, to me, I mean, look, I'm not a prediction guy. I'm not trying to say I got some kind of fundamental expertise here, but this just seems ominous.
I agree. I made a comment in a Bloomberg interview about 6 years ago. This is more the tail end of QE indefinite type of behavior, that really what these governments are doing is engaging in what would have been considered a Ponzi scheme by just continuing to throw money to bail things out. That hasn't ended. And it's almost as if at this point they've gotten so comfortable with being able to throw money at something that they don't believe there's going to be any consequences. Maybe I'm totally wrong and there won't be. But the fact that the U.S. government just passed $2 trillion in a matter of days, where they were fighting for months over $5 billion to fund a border wall, is just unbelievable to me. It's so easy for them to spend that kind of money that quickly and without really even knowing exactly how it's going to happen. There's going to be consequences. There has to be consequences at some point. But right now, it's just not in the cards. As long as the Fed keeps holding rates down and this money can be funded cheaply and companies continue to borrow cheaply, I think you don't have a day of reckoning. It keeps getting pushed off.
You had this nice, not altogether straight line up, but we get to the bottoms of March of 2009, and all of a sudden behind the curtain, the Wizards do a few things, and the next thing you know, we didn't really have to pay much of a price in many ways for the for the real estate crisis of 07, 08, 09. I mean, just we all kind of watched the Big Short movie. And then when it was over, I was like, oh, everything's over. Everything's fine. But something started building up, as you kind of hinted at. I think what's really interesting about Corona hitting right now is a lot of people just want to talk about, especially, again, the politicians, they want to talk about just Corona and this one thing. Of course, it's awful, but this one thing out of nowhere. But it's kind of one thing, a trigger out of nowhere, hitting a system that was about as goosed up as you could possibly get it, wasn't it?
Well, that's the interesting part. You've had people talking about how much better condition the economy's been in and banking industry going into the Corona crisis than we had previously with, say, 2007, 2009 period. The reality was we really did juice the economy globally with easy money, with tax policy. What did we get out of that? Global growth in developing countries that was 1% to 2%. I just don't understand how people consider that to be on solid foundation. When you look at the stock market, what people were paying and the PE ratios increasing, and you kind of just break it apart into simple components and you say, okay, so you've got out of the earnings that corporations have been making, roughly half, a little less than half of that has gone out to dividends, and the other half has gone to share buybacks. They've been borrowing to generate growth and investment. That's only been possible because rates are so low. But now you've got indebtedness in the corporate sector that's at record levels. There's a lot of things that aren't right. People will look back probably in 2 or 3 years and go, oh, that was obvious. But right now, nobody's even talking about it.
I said that you've got an interesting Rolodex. We don't need to name drop it all, but if you were to call some of your buddies and you're not talking to me here on the podcast so everyone can listen and you're just kind of talking amongst each other, do you have a gut level feel if the government's going to be able to tidy this one up fairly quickly? Or do you have a feeling that this is more of a 2000 to 2002 or 73, 74 couple year or longer event?
I definitely think it's a couple year or longer event. Going to be a reactionary kind of policy that we see taking place. Something happens, the government steps in and patches that. Something else happens, they jump in and they patch that. There's nothing, you just see it in their tone and what their optimism, what they want to believe rather than what is objective and what is actually occurring. They want to believe that what they're doing at each level as a reaction to what occurred is sufficient. As they find out it's not, they'll do something else. But there's no plan to make it solid out of the gate and doing really sort of what if scenarios. And the other thing is, why does it keep falling back to government? I mean, that's not the role of governments, is to bail out economies. That didn't used to happen. But again, it's what I talked about 6 years ago, this Ponzi scheme mentality that's really gotten emboldened over the last 20 years as government found out, wow, we can throw money and we can make these policies. We can buy up trillions of dollars worth of debt and fund it through our own purchases as long as we keep rates down. So they've got that mentality that they can keep this ball rolling. But I do believe at some point, the reactionary policies and the just continuing to buy up debt and issue more debt to be able to pay and patch things over, there has to be at some point how it comes home.
So we lay out kind of the scenario and people can easily see that it's a little pessimistic. And that's kind of the lay of the landscape. But you've got this entrepreneurial attitude. You've had it for a long time, lots of different ventures. Again, fund manager for a long time. Why do you have this entrepreneurial attitude? Why?
A number of years ago in the financial crisis with my brother, who's an architect, and he said there'll be a lot of obstacles thrown in the way, but people like us, he's saying, and there's just tens of millions of us in the country that are entrepreneurial, will always find a way. You don't find the way by just being optimistic. I'm optimistic that there will be solutions to things, but you have to be objective. I think it's a combination of, from my standpoint, of looking at things objectively and trying to figure out how I can surmount the problems that are there or take advantage of problems that are out there with my business and what I do with my actions.
You know, I remember back during the real estate crisis, everyone was talking about low unemployment, and then overnight we were at 10%. And again, the same kind of thing. I wonder, after having two of these lose your jobs on a huge scale, 2 events within a decade roughly, if people will reconsider the idea of putting all their eggs in that basket, or will people say, God, I really don't want to be caught. And this is why I was asking you about your entrepreneurial perspective, but I really don't want to be caught with my pants down, so to speak, again. Because I think at least if there's a hustle mindset, if there's I'm going to kill something on my own today and be able to drag it home and at least care for myself, that psychological feeling is really important, especially if you've been burned a couple times and believing that the system will take care of you.
I agree. And that's when I mentioned earlier about this more of a generational depression mentality that could take hold here. I really do feel that people will start to say, okay, I don't want to be in a position again where I lose my job and I have absolutely no savings to back me up. I don't have any contingency plan in place for how am I going to survive if I'm not getting an income that's coming in. And you saw that after the generation after the Depression, where people were savers, they were low risk takers. They did everything they could to become as self-sufficient as possible. I think we're going to see more of that mentality. And I'm not talking about people that are building bunkers necessarily, although I think there'll be an increase in that as well. But I think just people that will not rely on someone else to take care of them as much as we've seen. There's been this trend towards socialism. I think there will be more of a trend towards independence following this, where people don't want to be dependent on the social welfare and being provided by others to the extent that they are dependent on that today.
But on the flip side, to take the devil's advocate argument, a lot of people are probably going to be in panic mode if somebody comes along and says, here's your bag of gold just for being a citizen. A lot of people are going to say, thank you, sir. Can I have another?
Yeah, unfortunately, you are correct. As I was saying that, I was also thinking that we've got a certain group that'll be dependent and even become more dependent on being provided for rather than finding their own provisions. Unfortunately, that may mean that instead of bringing people together, this breaks people apart even further.
You mentioned the Great Depression generation, 30s and whatnot, and the idea of becoming a saver after that event. Now, if you start saving, though, that equals less consuming. Less consuming equals less corporate growth. Am I onto something?
Absolutely. I think that's one of the contributors to this having a long tail. I don't see the snapback. People talk about the snapback after the financial crisis. We really had a year or two of strong growth before it went into more of a long-term malaise for the last decade with that moderate 2.5% GDP growth, and that's in the U.S. Obviously, other developed economies were doing even worse. But that snapback was because of pent-up demand for housing and for autos, which come to the two main areas. I don't see that same pent-up demand in this cycle. What I do see is more of that saving and retrenching that'll take place. It'll just cause that longer tail and more of a drag on the economy for a number of years.
I'm jotting down on a piece of paper here, March 2020, and I talked about it at the top of this episode, some of your background and folks that you know in the industry. So if you kind of look back over the decades, your style of trading, friends that you know, their style of trading, it wasn't exactly a surprise. It really wasn't for myself either, but it really wasn't a surprise that when they lifted the blindfold off of March 2020, that a certain style of trader was standing there with gains who probably did not even want to raise their hand and say, we did well. Given the totality of what's going on across the world, no one really wants to hear of a winner when everybody else is doing bad. But it really wasn't a surprise to you in March of 2020 that there were winners and you knew who they were.
Right. I mean, you obviously had some huge trends that took place. This great increase in volatility that you had definitely benefited managers who had a long volatility outlook or momentum type traders. The guys that got damaged were ones that were playing some sort of either sort of an arbitrage type play or reversion to mean type strategies that have worked so well for the last decade, where things just always kind of came back into line. And this totally flipped the types of winners and losers that we had over the last decade.
Speak to your view right now. Again, there's a lot of different strategies in your background and whatnot, but your particular view of the last handful of years and how you've been helping clients, the mindset or the perspective that you came at, and I'm going to let you explain it, but if I had to kind of generalize, I would say you looked at the industry as a whole and you said, okay, most people are long only, they're buy and holders, but they also have a memory of a couple 50% drawdowns in stocks in the last 20 years. Can I give them something that can mitigate that when something like a March 2020 happens?
Right. So I guess you could say we've had two stages in our thinking over the last decade, and the most recent just shifted over the last year or two. That originally, going back 40 years I've been in the business, our focus has been on providing non-correlated strategies to investors and investment programs that could profit across a variety of economic conditions. They didn't have any particular condition or environment where they necessarily really kick butt. It was designed to be broadly diversified globally across multiple return drivers. So what that did was provide reasonably consistent and reasonably predictable, and you always have to use the disclaimer, nothing's consistent, nothing's predictable, but returns across a variety of environments. And we thought that was the best way we could help people diversify their portfolios. What we saw over the last decade was less and less interest in that approach. And as the US market dominated the world markets and outperformed virtually every other market globally, that's where the money kept going. And it reinforced the belief that all you needed to do was put money into the US market, you bought it, and you held on to it. To the extent that that is just absolutely prevalent even today, where people are looking and saying, is this the time to buy more? Not, should I be concerned about what might happen over the next 10 years? What we did last year, and it grew out of a consulting project we had with a large family office client, is we developed a approach that combines what people want to have, which is this long equity exposure, with put protection against it in the event something like what just happened occurs. Then we pay for that with what we refer to as our alpha overlay. It's a return driver based overlay, which is the trading we've been doing for the last 40 years. So it gives people a product that allows them to have that long exposure. It's what we define as a better way to buy and hold. They still get that long exposure, but it's protected on the downside, and the protection is paid for by the globally diversified return driver based trading that we've been doing.
Were your people happy with what you did for them for March of 2020?
Absolutely. I mean, it's performed exactly as we laid it out. When we first started presenting it to people, they would say, it can't be possible. All we're doing is options math with modern portfolio theory, which is diversifying a portfolio. We always like to tell the people it's not magic, it's just math. Once we lay it out and they can see it, a portion of them understands it and can accept it. But there's still just a large contingent out there that believes the only way that they should be investing in is buying and holding stocks, and that means U.S. equities. And I can explain why that is, but buy and hold U.S. stocks and essentially do nothing else to diversify their portfolio aside from maybe a spattering of fixed income.
How have you, well, let me say it this way. On the upside, I want you to explain a little bit more, but you buying puts costs money, takes away from something. You got to pay for that. On the upside, though, is any of the upside of this structure that you've put together limited by the put cost?
So the way it works is if you have 100% long equity exposure, you start with that. You buy put protection against that and just naively assume you're buying 1 year leaps at the money each year. That cost, assuming there's no value ever provided by those puts, the raw cost on that averages around 5% a year. So then let's look at it and say, okay, now we can let's try to pay for that put protection. The normal way that people do that is staying within the box, and they might sell some more further out of the money puts to collect some premium, sell some calls, they caps their upside to collect some premium to help pay for that. All we're doing is saying, no, we want the put protection to be purely there to protect against the downside. And then what we do is we overlay the future strategy that we've applied globally for the last 40 years on top of that. we set that up to pay for that put protection, which requires to generate, say, that 5% annualized return. The end result is what we call risk replacement. We have taken the risk required to earn the 10% annualized return on the S&P, for example, and we've replaced that with the risk required to earn 5% to pay for the put protection. And we've paid for that with a more diversified portfolio than just the S&P. So if you just look at it mathematically, conceptually, we've taken half the risk to offset the entire risk of owning the S&P 500. That in itself is just sort of the math behind why it works. And then when you combine it with the fact that the put protection actually doesn't cost 5% a year, because there's years where it pays off, like this year, for example. And just the put protection alone, if you put that on with the S&P, only reduces the top return of the S&P by about 1% per year. And that's going back over, we base back over 29 years to early 1990s. You're not really giving up a whole lot, even buying those puts, but you're taking that 50% drawdown, for example, in the financial crisis, and turning that into a 20% drawdown with the naive put protection. So mathematically, it's just something that makes a lot of sense. You layer in the alpha, not only you're paying for the puts, but you're actually enhancing returns over time. So you end up with a risk return profile that's about a third of the risk as measured by drawdown, with return that's actually in excess of what you would have with the S&P alone.
So this was often one of the messages you would hear from the CTA, quant, futures, trend following managers is like, take some of us and put it into that portfolio. But it's obviously, everyone knows it's never really reached the point that it should to have all the advantages for the people that need it. So it looks like what you've done is sat back and said, how do we take all of these smart things that I just rattled off? How do we take these smart things, put it in applesauce for people that just want to stay in their lane with the buy and hold and index and whatnot, and give them something that tastes nice, and they don't really have to consider whether or not they're adding in strategies that they don't, quote, understand and all that?
That's absolutely correct. Because what we've found, investing is not a rational process for people. It's an emotional process. And when I wrote my book a decade ago, that's really the underlying theme through that, is that people invest emotionally. They're not rational creatures when it comes to investing. What we were preaching as an industry, and the managed futures industry was preaching, was you can diversify your risk by adding some of us to your portfolio. What you found was that the emotional person on the other end that was buying stocks was constantly comparing the components of their portfolio, not the overall benefit. And they would say, well, geez, I'm making 15% a year here in this stocks portion of my portfolio, and this futures stuff over here, it actually lost money last year, or in the last 3 years, it's flat, or it's only contributed 3%. I don't need that. That's a drag on my portfolio. That's not beneficial. They've consistently concentrated larger and larger percentages of their portfolio to that long equity component until it's dramatically dominating the performance of their portfolio. What we did was say, we recognize that. That's how they're going to behave. We put together a product that gives them that long equity exposure, but protects them at the same time, and then pays for that protection and provides that additional portfolio diversification that's been preached all along, but people can't follow. Why we call it a better way to buy and hold, because it still gives them that buy and hold in their portfolio, but combines it with things that they should have been doing all along, but they can't do on their own.
I've got an audio cassette with you, and I can't remember who was on the panel with you, but I think it's from like 1992 in Chicago. And I think I saw you speak somewhere 94, 95, 96 in Chicago. And you sound exactly the same. You've been on this podcast multiple times, and you sound the same. You sound like you're 30, okay? You sound even-keeled. What do you do? Sometimes you talk to folks, and you can kind of tell they're kind of tuned out on life, or they're not even-keeled, or something's a little bit amiss psychologically. I'll tell you a funny story. I was doing this podcast last week, and I had a guy on, a professor. I rattled off some statistics, and I wasn't putting any judgment on the statistics. He got upset, called me a name. I had to hang up on him. First time ever in my podcast. Here's where I was going before that side tangent, is back to you. Why do you have this even keel? What is it about you? What do you do in your life? What's your routine? Why are you Mike?
I don't know. I've always been, I guess as you say, pretty similar to how I am today. early on started developing some of my own philosophy on how I wanted to do my business and how I wanted to live my life. And I haven't really had anything that impacted me that's caused me to deviate from that. It's only reinforced it more. When I look at people that are successful, some of them are emotional and just got lucky, but a lot of them are just, I don't know, I want to say plod along, but they have a pretty stable path they follow. They're not wild. They're not driving the fast Ferrari necessarily. They're just they have an approach and they stick with it. I've had a belief, I've had an approach. I stay with that. I've been fortunate to have a great family and just who I grew up with, my brothers and sisters, and now with my wife and 3 boys. Everybody's always been supportive of me. I think it's just been a great environment that I've grown up in.
Give me some influences. We'll stay in the trading, investing space. Influences either up close and personal for you or influences that were reading, studying influences. Who and what shaped you?
I early on was fortunate to be able to bump into some people who became legendary in the investment business and well deserved. I mean, they did some great things and not just made money for investors, but outside of investing world. Early on, I met John Henry at one of the early conferences. We spent some time together. John's obviously gone on to some great successes, just had a philosophy, stuck with it. It worked well for him for a number of years. Guys like Paul Jones, who I allocated money to. Paul had less than $1 million trading his own money when I first met him in the early 1980s. He was just the guy that in his 20s, you could just feel the maturity that he had, the ability and the approach that he had that was so disciplined. And I just remember seeing him on Barron's had like a round table every year and talking about his views on the market. I'd get his statements and he might have an opposite position on it. I don't think he was talking against it. I think it was just a week before when he was on the panel, he had a view, but he changed it. So he had the flexibility. He never got locked in as other experts would into a view they had. And I wrote about that in my book about how experts generally are about a third right. It's well documented. There's been a lot of studies on this. And it's because they get locked into a view that they've publicized. They have to stick with it, even if the circumstances change. It should change their viewpoint, and they don't. As much as my core beliefs have always been the same on a day-to-day basis, I'll allow for that flexibility.
Yeah, I think it's a great point. That was not to go back to my little story about having a guess problem, but that was part of the problem because I was just sitting there asking questions and trying to dig into the data. I all of a sudden realized, oh, I guess he's kind of tied himself into this box. If he goes outside the box that goes outside his book, you could kind of just feel like he can't go there. Whereas you just said, okay, Mike saying to Mike, yeah, I've got my core beliefs, but I'm open. And I think that's such a nice way to go through life, to be open. I would hate to be in a situation where somebody was saying, oh yeah, that guy Mike Covel, he can't really talk because he's wedded to this and he's in this box. And if he leaves that box, something bad happens. Exactly where you're going, which is just to be intellectually honest.
Right. I think that's so important. I do change. I used to have a comment when people would be looking at our strategies and asking us how we traded. And I'd say, look, when we develop something, I'm 100% sure that I'm right. But my beliefs on each of these different strategies probably have a 2-year half-life. So I'll believe that. But if I'm proven wrong, we'll change. We'll adapt to that. And I would find fairly regularly that maybe my initial thought that I was so convinced was right, 2-3 years down the road, I start realizing, you know what, I was off on that one. And you need to have that flexibility at that sort of lower level of trading strategies and investment concepts and ideas, because the environment does change. But overall, you have to have that overriding philosophy that's consistent. And I think that's what I've seen in some of the 2 traders I mentioned earlier. That's what you could see in them. They had a consistent philosophy, even though they may be prepared to change their viewpoint even week to week in the case of Paul Jones, based on changes in the environment and the markets that he was looking at.
It's an interesting point you bring up about those guys because they were both in their early 20s. Maybe John was a little bit older, but that they had that gusto and that understanding, and people believed in them at that age. Whereas I think today, a lot of people have kind of created this teen, 20, 30 something that just kind of goes on forever. And no one has to kind of stand up and be counted and show some maturity and actually say, you know what, I can bite that off and chew it. I'm 27 years old. I can do it. Whereas people say, no, he's only 27. He's too young. There's really been a mindset change, I think, since when you grew up.
The only place you see that old mindset, I guess, is in the tech industry.
Yes.
Where people are revered the young age and having that innovation and running with it. In finance, it's really gotten to the point where there's only a few beliefs that people are firm in. And one of those is that buy and hold belief. The fact that you just buy and hold and the market goes up. It's been reinforced over time. And I mentioned earlier that I would explain why that belief is so prevalent in the US. If you look at the global markets, and I had written about this before, if you go back to 1900, where you had 36 global markets that were existent at the time and actively traded, only 4 of those survived to the end of the 20th century without a major disruption or total loss of investor capital. The US was one of those, Australia was one of those. There were just a handful. The reason today that buy and hold is just such a firm belief in the United States is because that has worked since it's been preached in a very powerful way. And every setback has reinforced that you should not sell, because 2-3 years later, if people sold at that bottom, which is when they sell, that would prove to be a mistake. But if you look at other economies, you could just start rattling them off. I mean, starting with Japan, which is now 50% down from 30 years ago peak. France, you've got the UK now, all these markets that are lower than they were prior to the financial crisis. Australia, China, Hong Kong, Singapore, Spain, Italy. I mean, you can go through dozens of different stock indexes and markets that are lower than they were 15 years before. Those people aren't preaching buy and hold. Buy and hold, it's not a proven philosophy. It's just an observation. In the US, if you look back, you should have just continued to buy and hold. It doesn't mean that's the right thing to do now going forward. That's where people aren't thinking. Is the environment different today? And what I wrote about before was buy and hold, even in 1900, with those 36 stock markets, those countries, only 4 of them survived intact. That doesn't support buy and hold. It only supports buy and hold for those 4. But even in those 4, are the environments, the baseline conditions that you had for those 4, similar to where they were in 1900? Well, the U.S. was an emerging economy with $16 billion GDP in 1900. It's 1,000 times bigger than that today. Is the same baseline condition, is the belief in why you should buy and hold then, does it apply today? Think about that going forward. I could argue both ways, but the fact that there's not just one way to argue it means that you really need to be thinking about doing something else with your portfolio than committing a vast majority to buy and hold.
The other thing there too, and this is not something a lot of people are either trained to do or want to do, but the opportunity cost. I mean, if you throw it all in now April 2020, throw it all in to quote buy and hold, some of the issues that you've brought up in this conversation, you really got to say, are there going to be better opportunities in the next 5 to 10 years than just trusting buy and hold? And I think that's what you're really getting at, is sometimes there are these paradigm shifts. Maybe this is not one, but it sure as heck is something. I mean, this is just not normal at all. I mean, everyone could look at the quote unemployment numbers. I mean, it's off the charts. This is just one of these events that is like, we have no one living has a prior experience in anything like this.
Right. I mean, employment numbers are order of magnitude off the charts from what we've previously experienced as an extreme. The problem you have, I think, is that people they've narrowed their investment beliefs and focus, I guess, now to either I'm long equities or I'm long fixed income. And we're back into that sort of very primitive thought process right now. So just yesterday, I was talking to a financial planner who's saying that I have to keep people in stocks. We have to be buying more stocks because there's no place else to go. And I've been hearing this for the last decade.
Hold on, that's how they get paid.
They do, but he's now, because he's fee-based, he's now making a third less than he was making because he's put so much money into equities and they've gone down. So he's got less money to work with and get paid on.
It's more of an issue of just bad strategy.
I think it is because they don't look at the other opportunities that they have available. I talked to an elderly investor, 85 years old, who's got all his money in equities. His comment was, well, I can't take it out of there because I won't make money anywhere else. And my comment to him was, well, what happens if you don't make money in that? What happens if you do have a Japan scenario? And for the next 30 years, it's still half of what it is today, 30 years from now. That would change everything. Because prior to that, he was saying, I'll just ride out any drawdown, any sell-off. I'll ride it out. I at least got him to start thinking that maybe, even if you're not going to look at the other things that are available to you, you just put it into cash. That may make you 30% because you would have lost 30% in equities. Maybe. But you at least have to consider that. Right now, the consideration is not out there for that.
That was very slick how you just did that. I'm sure a lot of people did not catch that just by being in cash, you'll make 30%. What do you retrace that one for people?
Well, they don't think of what they might give up or lose by maintaining the investment. They just are looking and saying, what if I move that investment? What am I giving up? And in their head, they're getting a return. It's just postulated that they're going to get a return on that equity investment. But what I'm trying to get them to think about is, what if that's not the case? What if it does go down 30%? Being in cash just saved you that. It made you that 30%. That's the only thought process I'm trying to get them to make. I'm not trying to make them leap to, okay, you could do these globally diversified portfolios across return drivers, and there's all these other ways that you could diversify your portfolio. I'm not even trying to get them to make that leap. I'm just trying to make them at least see that there may be a risk that you can offset by moving out of that other long equity position.
Go into your alpha hedge strategy right now. Go into it in the sense of just the quick example of, we've had these two S&P 50% downs. Perhaps we're in the middle of a third right now. Who knows? But we've had these two S&P 50% downs. How did your alpha hedge, going back and looking at it, how did that perform during that period? So this, again, is somebody who's just index, S&P, they took the 50% hit. If they would have gone with your mindset that you're employing, what would have been the alternative?
Again, just with the naive approach of buying those one-year puts at the beginning of each year at the money, in the financial crisis, you would have turned that 51% drawdown, and this is on the total return index, dividends reinvested, in the S&P into a 17% drawdown in that period. The advantages, and that people are, I think, starting to understand, is what that means is, instead of having 104% return to get back to even, after that 104% return, you're up over 60% in your portfolio if you've mitigated that drawdown. Just the mere fact of reducing loss increases your returns. All that's just proven out from the put protection that's in the portfolio. And like we say, it's not magic, it's just math. The math is there, it supports that.
Have you become a lot more popular now after March of 2020?
We have a few different Zoom conference calls today. We've got tomorrow. We're starting to talk to people more than we have. What's interesting is the response. We started out, I guess I'll call it preaching, the virtues of this approach to people towards the end of last year. And our approach to them was, look, this bull market's long in the tooth. It's at record length. PEs have been extended. There's some reasons why maybe you want to help protect your portfolio. And we explained how this would help them protect their portfolio. Nobody really bought into that because they didn't think they needed to. If you could just buy and hold, you ride out any drawdown. Why protect against that drawdown? Today, we're seeing what's really interesting is nobody wants protection. They feel the damage has been done. If anything, they're looking, should I add more to my portfolio at this point? That is universal. It's unbelievable how universal that viewpoint is. Nobody, as I mentioned earlier in this, nobody's looking at the downside. They're just saying, what is the upside? And the most bearish scenario that we've seen yet on the street is a 4% rise from current levels by year end. Not a decline, increase. That's the bearish case. It's unbelievable. So what we're seeing now are people that are saying, okay, can you protect me if it does happen? There's some probability of that. I understand that. but I want to make sure I catch this rise that's going to occur here. What we've been pitching more now is how the diversification that we embed in this portfolio through the alpha overlay can enhance your returns over time. So we're not talking the put protection because people don't think they need it now. They think that's been done. The horse is out of the barn. It's crazy, but we're back to talking portfolio diversification.
I still remember too, when the dot-com bubble burst, I think March of 2000, there was a lot of that kind of hanging around and whatnot. And it wasn't until the fall of 2002 that I really see people throwing their hands up and saying, gosh, I've got to look at something different. You really needed to get that NASDAQ down 77%. And then people were all of a sudden like, hey, okay, there's got to be something else out there. And then, of course, we goosed the system back up to get us to the real estate crisis. So it will be interesting to see how things unfold, huh?
Absolutely. Yeah, I think right now there's just so much bullishness. It's weird to say that when there's so much fear going on right now. But when you actually ask people what they're doing with their money, they across the board believe the best thing to do is either ride it out or buy more.
There you go. Mike, you're offering a different message than that. If people want to find you, check you out, have a conversation, check out what you're up to with your firm, where can we send them?
They can go to brandywine.com, or a second alternative is we have a brief video talking about what we're doing with Brandywine Alpha Hedge at abetterwaytobuyandhold.com.
abetterwaytobuyandhold.com. Easy enough. A little long, but easy enough. Easy to remember.
Yeah, very good.
Mike, listen, I appreciate it. Again, guest number one, now guest in the 800s somewhere.
That's impressive. You've done a great job, Mike.
Hey, thanks again, Mike. Hopefully we will talk again in the not too distant future.
Thank you very much.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.